Ind AS 33. So question number 35, page number 100. Given below information regarding the capital of a company, 40 lakhs equity shares at the rate of rupees 3.50, 140 lakhs. 9 months later, the company had issued 1 for 4 share scale, given rights to existing shareholders at the rate of rupees 2.80. Find out bonus element in rights issue. Also find out weighted average number of equity shares for the current year and the previous year. Question number 35, page number 101. So whenever you get rights issue, there is always an element of bonus shares to it. Step number 1, x equal to m into n plus r into s divided by n plus r. Vignesh, the fan matra off and so 4 shares are issued, or 4 shares are eligible for 1 rights shares. And market price per share is 3 rupees 40 paisa. One into 2.80 divided by 4 plus 1. 3.5 into 4 and 1 into 2.8. 16.80 divided by 5 is 3.36. Step number 2. Bonus factor is equal to m into x. 3.50 divided by 3.36. Three point five divided by 3.36. 1.04167. This is what we consider as bonus factor. Step number 3, weighted average number of equity shares. So one should find out by what point of time they had this. Number of months prior, number of months after, number of months before. 9 months later only it had happened. So this bonus factor is to be applied only for the period prior. That is what we have noted down. So how many number of shares that you are having? 40 lakhs. 40 lakhs into how many months? 9 months. 9 by 12 into 1.04167. Then here 40 lakhs plus 1 by 4 into 40 lakhs into 3 by 12. 40 lakhs into 9 by 12 into 1.04167. 3 lakh 12,000. 31 lakhs 25,010. 50 lakhs into 3 by 12. 12 lakhs and 50,000. $43 lakhs 75,000. Say I'm rounding it off because approximation only they're doing. So weighted average number of equity shares 43 lakhs 75,000. Then this is for current year. Weighted average number of equity shares for the previous year 40 lakhs into 12 by 12 into 1.04167. 40 lakhs into 1.0467. 4167. It is 41 lakh 66,667. Okay, come on, kindly make note. So the question is all about bonus element and weighted average number of equity shares for the current year and the previous year. Come on, kindly make note.
Noted, sir.
So then question number 36, Danesh will read out this.
Net profit for the year ending 31st March 2016 is 11 lakhs. Net profit for the year ending 31st March 2017, 15 lakhs. Number of shares prior to the rights issue is 5 lakhs. Rights issue rate is 1 for every 5. Fair value prior to the rights is 21. Subscription price for the rights issue 15. Rights issue was made on 1st May 2016. Find out the EPS basic for the year 2015-16 and 16-17.
Now let's just go through the problem. Net profit for the year ending 31st of March 16, 11 lakhs. For that, they have given you the number of equity shares as 5 lakhs. And then they are talking something about fair value or prior to rights 21. But the subscription was taken up at 15. The rights issue was made on 1st of May. They follow April to March accounting year, and we are expected to take it up for the 2 years. In fact, 3 computations that we got to work. Question number 36. Page number 102. Say number 1, current year 15-16. Net profit for the year 11 lakhs. Weighted average number of equity shares
5 lakhs.
5 lakhs. Earnings per share basic
2.2.
2.2. Mute பண்ணு கோபாலா. Day number 2, weighted average number of equity shares basic, and for that step number 1, x equal to m into n plus r into s divided by n plus r, 21 into 5 plus 1 into 15. So it is 105 plus 15, 120, 120 plus 6, 20. Step number 2, bonus factor is equal to m divided by x, which is equal to 21 divided by 20, which is equal to 1.05. Step number 3, weighted average number of equity shares. Weighted average number of equity shares is prior. How many months prior? That is for the month of April only. April only. Number of shares 5 lakhs. 5 lakhs into 1 by 12 into 1.05. From May to March, 5 lakhs plus 1 by 5 into 5 lakhs into 11 by 12. So 5 lakhs into 1.05 divided by 12. 43,750. Am I right? So then
Correct. 5 lakh 50,000.
5 lakh and 50,000. 5 lakh 93,750. Previous year, 5 lakhs into 1.05. 5 lakh and 25,000. Okay. Day number 3, 16, 17 and 15, 16. Current year and previous year. Net profit. என்ன கிளம்பிட்டீங்க? சரி, அங்கே மாடியில் மேடம் பார்த்துட்டு போங்க, கிளம்புறேன்னு சொல்லிட்டு போங்க. 11 lakhs and 15 lakhs. Weighted average number of equity shares 5 lakh 93,750. I'm sorry, 14 lakhs and 11 lakhs. 93,750 and 5 lakh and 25,000. So earnings per share 15 lakhs divided by 593, 2.53. 11 lakhs divided by 5 lakh and 25,000, 2.10. நீங்க நீங்க எடுத்துன்னு வந்துட்டீங்களா? சரி, வச்சிரு. Or previous year's EPS divided by bonus factor. 2.20 divided by 1.05. You get this. This is what you call it out as adjusted EPS. Come on, kindly make now. That is an EPS that was already developed, which got adjusted on account of an event which happened in the following year. Is it okay?
Noted, sir.
Right. See now, diluted earnings per share were if these potential equity shares were issued in the form of equity shares, the earnings per share might drop That we have got to announce it beforehand. That is what the philosophy behind going in for diluted earnings per share. And now let us just take up on to question number 37. So 37 has got two questions, 37A and 37B. Both are totally independent, and Rajagopalan will read out 37A. Come on.
Find out diluted earnings per share from the following. Net profit for the current year rupees 1 crore. Number of equity shares outstanding throughout the year 50 lakhs. 12% convertible debentures of rupees 100 lakhs of rupees 100 each. Each debenture is convertible to 10 equity shares. Income tax rate 30%. Find out basic earnings, diluted earnings, weighted average shares basic, weighted average shares diluted earnings per share.
So they are asking find out diluted earnings per share. Net profit for the year they have given. On income tax rate, when they have mentioned, what is a conclusion that we got to make? Whether the net profit is before taxation or after taxation. So
Before taxation.
After taxation.
no, see, without really knowing the impact, we might conclude that it is income tax before taxation. So in fact, let me tell you, after the study of financial instruments, you can have preference share capital, which can be treated as what? Which can be treated as liability, or which can be treated as
Equity.
equity. And in that process, you would also be having effective rate of interest to be used. So whatever you just find things which are apparently taken up as preference dividend may not be the figure that in P&L account that we would be debiting. We will find out effective interest rate, and accordingly we debit. And that sort of work we have already done. So if such is the case, when you have preference share capital, which is considered as a liability, and when they give you net profit for the current year, should that preference dividend, I mean, should that application that we used to have effective interest rate, so you would have just seen the amortized cost schedule. So you will have opening balance, you will have interest, you will have a cash flow, and we will arrive at the closing capital. Remember that we used to have opening and interest, cash flow, and closing. So the effective rate of interest may be 12% and cash flow may be 9%. So we find out the opening capital, we will arrive at 12%. This is a cash flow that we deduct, and we will arrive at the closing balance. Now, this interest is the one in P&L account we would have debited. And now the question is that the net profit that is after deducting towards interest or before deducting towards interest. So one need to check before we could proceed further. We should only be understanding that in India, yes, the effective interest rate is computed. We have already debited them in P&L account. We are not expected to deduct once again. So to make this particular point a little more clearer, so I would like you people to copy one particular page where it is summary, there is the entire summary just brought in the form of a chart. So if you just note down the chart, it is a full page chart only. So this is what you have. Treatment of after-tax amount of preference dividend in calculation. Say if the nature of preference has to be cumulative or non-cumulative. In the case of cumulative, deduct after-tax amount of preference dividend from P&L account, whether dividend is declared or not. In the theory that we have noted down on the other day, we have just stated this particular point. In the case of non-cumulative, what is that we are expected to do? Deduct only when it is declared. That is what we have noted down. So what is the treatment for cumulative and non-cumulative? We have conveyed. Other adjustment to P&L account attributable to the parent company, if any. So all these issues, whether preference dividend was issued at discount to premium, and we have effective rate of interest. So this is not only applicable for only when you have parent thing. Even in a separate financial statement, we are expected to take into consideration these things. So the amount of preference dividend for the period does not include any amount of for cumulative preferences paid or declared during the current period in respect of previous period cumulative arrears of cumulative preference dividend should not be deducted is what one of the points we have noted. Do you remember that? That is arrears. You people have tend to forgetting.
No, sir, arrears should not be taken, sir.
No, that is what they are telling. And, that point I just written. No arrears of preference dividend shall be deducted is what I told. That is what institute is saying. Of the previous period, you cannot deduct is what they are telling. So the term net profit for the year, we should only be understanding that they are all after deducting towards those preference share capitals which were classified as liabilities and against which instead of naming them as preference dividend, we would have deducted in the name called finance cost using effective interest rate method. Is that clear? Have that in your mind. And before we could just proceed, I want you people to copy this in your notebook because I know that we may tend to forget all this. Make a quick noting, or else what you do is that you leave a page there in your notebook and make note that it is there in page number 11 and that is 11.41, and at home you can leisurely make note. Is it okay? Leave some space and take note about the chart.
Noted, sir.
அதுக்குள்ளயா?
இல்ல சார், இந்த பேஜ் நம்பரை மார்க் பண்ணிட்டு.
Okay, good. That's great. Now let us take up this particular problem. Workbook problem we can take up. Shall we?
Yes, sir.
So now let us just try. In this problem, we are not having preference share capital, but matter related to dilution is taken up. Question number 37A. Number 1, basic earnings. ₹1 crore. Basic weighted average number of equity shares basic. ₹40 lakhs. Basic EPS ₹2. Then number 2. 12% convertible debentures we have. So dilutive earning equal to basic earnings plus interest on convertible debentures after tax. Because this is after tax, no. Therefore, that should also be on after tax basis. 100 lakhs plus 12% on 100 lakhs into post-tax rate of 70%. The whole divided by, I'm sorry, that is only for EPS computation. Plus 8.4 lakhs. So 108.4 lakhs dilutive earnings. 3, weighted average number of equity shares 50 lakhs. 4. Weighted average number of equity shares dilutive, which is equal to basic variance plus potential equity shares. Basic weighted average number of equity shares 50 lakhs, and conversion is 100 lakhs of rupees 100, which is equal to 60 lakhs. 5. Dilutive earnings per share, which is equal to 108.4 lakhs divided by 60 lakhs. $108.4 lakhs divided by 60 lakhs, which is equal to 1.81. That's it. Come on. Next.
1 minute. மேல
The last two lines, sir.
ஒரு நிமிஷம் மேல
So the last line would be, sir. Very last.
ஒரு நிமிஷம் முடிச்சு
Hmm?
ஒரு நிமிஷம் நோட் பண்ணிட்டு
Noted, sir.
Muralidharan, noted.
1 minute. Sir, once on the no.
Noted. Is that over?
Over, sir. No touch.
Okay. Yes, Muralidharan, could you read out B part 37B?
Yes, sir. Find out the impact of dilutive earnings per share on basic EPS, potential equity shares. Options 1 lakh with exchange price of rupees 60 and fair value of rupees 75. Convertible preference shares. 8 lakh shares entitled to a cumulative dividend of rupees 8 per share. Each preference share is convertible into 2 equity shares. Attributable tax example CDT 10%, 12% convertible debentures of rupees 100 each. Nominal amount of rupees 10 crore. Each debenture is convertible into 4 equity shares. Tax rate 30%. Dilutive earnings 100 lakhs. Basic gains 20 lakhs. Find out earnings per share, basic diluted earnings per share.
Right. See, whenever you have more than one potential equity shares, you got to prioritize them as which one is most dilutive, second most dilutive, and last dilutive. This is what we are expected to do. Now let us just do that. So here we have option, we have preference shares, and in the case of debentures, we have convertible debentures. 3 items we have. So how do we work out that? So whenever you have a problem like that, you should rank them as most dilutive, second most dilutive, and so on. 37B. So first one, how we rank is impact in earnings. See, whenever you have a dilution, it is an adjustment that you carry out both in numerator and denominator. Numerator stands for earnings. Impact in earnings. Impact in weighted average number of equity shares. Then impact in EPS. Correct. Then rank in the order of most dilutive. First one, options. See, options where there is no impact in your numerator. Always remember, for option, which is always the most dilutive one, there is nothing we will add. You would have seen in the last case, for debentures we have added back. There is nothing we will add back in the case of options. So with nothing to be added in the numerator, when something is to be added into the denominator, it indicates that it is going to have dilution, and such dilution will be the most dilutive one, because no increase in income. It is something like a partner is admitted. Because of his admission, client base had not gone up. On account of him, there is no increase in the revenue, but he is sharing in the profit would mean naturally others' share will come down. So impact in weighted average number of equity shares. So they have given as 1 lakh. So 60 rupees being the excise price and 75 rupees being the fair value. So 20,000 is the impact in weighted average number of equity shares. So people might ask this question, sir, how do you know this? We are going to develop one working notes. So working notes, how do we do it? So fair value minus exercise price divided by fair value into number of shares in the options. So which is 75 minus 60 divided by 75 into 1 lakh. So 20,000 shares. So this is the straight formula. So this is alternative one, straight formula. So where I'm not giving you the logic as what is the logic behind this straight formula, I'm using it. But now I'm going to give you logic. Alternative two, logical understanding, which you say deduction. Deduction means how you reduce it. That is deduce it. Deduce it in the sense logical conclusion. 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 So imagine 1 lakh shares at the rate of rupees 60 would mean 60 lakhs you collect. Then try the same 60 lakhs at the rate of 75. At the rate of 75 you collect. How many shares you would have issued?
80,000.
So the difference between the two is 20,000 shares, and that is what you have between the two. Exactly the same bonus element in rights issue, same way you do have. So this is going to have zero impact. So close your eyes and say this is the most dilutive one. That is number one. Then number two, convertible preferences. Convertible preferences. What sort of impact it is likely to cause? So it is 8 lakh shares entitled to a cumulative dividend of 8 per share is what they given. So and you have corporate dividend distribution tax of 10% you have. So it is 8 lakhs into 8 into 110%. So if this preference shares were not to be there, this much of reduction will not be there at all. So how much is that? 70,000. 70 lakhs 40,000. Correct? So this much of preference dividend and outflow towards taxation all put together, this much of increase will be there in the earnings. So how much will be in the form of weighted average number of equity shares? Each preference shares is convertible into 2. So 8 lakhs into 2, 16 lakhs. So 70 lakhs 40,000 divided by 16 lakhs. 4.40. I can't rate it as second or third unless I know something more about convertible debentures. Convertible debentures.
Sir, doubt.
Yeah, what is it?
அது ஏன் 110% மட்டும் முடியும்?
So if you pay 100 rupees as dividend, you got to pay dividend, corporate dividend distribution tax 10%. So your total outflow and impact in your P&L account will be 110%. Where it is given attributable corporate distribution tax. Nowadays you don't have, for the last 2 years you have this. Prior to that, company was paying this tax on behalf of shareholders, and that is what we call it out as a distribution tax. Okay.
Understood. Okay.
Convertible debentures. What is it you have in the case of convertible debentures? You have 12% on 1,000 lakhs. 12% on 1,000 lakhs into 70%. How much is that? 84 lakhs. Correct that? கரெக்டாக தான் போட்டுருக்கோம். So convertible debentures is each debenture 4 equity shares and each debenture 100. So in 1000 lakhs divided by 100 into 1 for every 4. Sorry, 4 for every 1. $40 lakhs, huh? $2.10. So this is second most dilutive and this is the least dilutive. So the question is, they have not asked anything like that. Firstly, copy to this extent, and then I will tell you as how it is to be done in the case of dilution. Come on, kindly make note. Potaja. Yes, have you copied?
Working on that.
Working notes copy.
If you're copied, please let me know. I'm just waiting for you. Don't take much time. please.
Noted, sir.
Noted, sir.
Right. See, now the question is to find out basic earnings per share and diluted earnings per share. First one, basic EPS is equal to basic earning of 100 lakhs divided by 20 lakhs, which is equal to rupees 5. How diluted earnings per share will be computed? Earnings, weighted average number of equity shares, EPS, and remarks. Number one, which is given in the problem as 100 lakhs, 20 lakhs, 5. Then first of that comes in the form of option. It will not have any impact in the earnings, but it will have impact here. Is 20 lakhs. $20,000. So the change will be 100 lakhs and 20 lakhs and 20,000, which will cause definitely reduction in EPS. Divided by 20 lakhs, 20,000. That is 4.95, which is dilutive. Why? 4.95 is less than 5. This is a first rank. Next one to be taken is convertible debentures, second rank. Second rank. What sort of changes this is likely to cause? 84 lakhs. What sort of changes you find there? 40 lakhs change. Correct? A crore and 84 lakhs. 60 lakhs, 20,000. A crore and 84 lakhs divided by 60 lakhs, 20,000. That should give you 3.06. Dilutive only. 3.06 less than 4.95. Don't compare it with 5. Then convertible preference shares, last rank. What sort of impact this is costing? 70 lakhs, 40,000. And it is 16 lakhs. Am I right? So 254 lakhs and 40,000 and 76 lakhs and 20,000. 254 40,000 divided by 76 lakhs 20,000. It should give you 3.39, which is anti-dilutive. 3.39 is greater than 3.06. Then what is diluted earnings per share? So diluted EPS is 3.09. There is a chance that it may drop to the least. So what had happened is that you can say when you increase this, before it was 5 or it was 5 like 5. Then it came to 4.95, that come sharp decline. $3.39. Okay, which is the lowest bottom 3.06. So therefore 3.06 will be the most dilutive EPS. Come on, kindly make note. Shall I proceed to next?
The last one, sir. Noted, sir.
Noting, sir. Current,
ஒரே நிமிஷமா.
last one. Noted, sir.
Okay.
Note பண்றேன்.
Okay. Illustration number 1 in Institute study material. Yes, Rajagopalan will read out this problem. Come on.
ABC Limited issues 9,000 preference shares of par value of rupees 10 each on 1/4/2021. Total value of the issue is rupees 10 lakhs. The shares are issued for a period of 5 years and would be redeemed at the end of fifth year. The shares are to be redeemed at rupees 11 each. At the end of year 3, that is on 31/3/20x4, company finds that it has earned good returns than expected over last 3 years and can make the redemption of preference shares early. 2. Compensate the shareholders for 2 years of dividend which they need to forego. Company decided to redeem the shares at rupees 12 each instead of original agreement of rupees 11. Comment on the impact of early conversion of preference shares at a premium on earnings for the year 20x3x4 attributable to ordinary equity holders of ABC Limited for basic EPS. Ignore the EIR impact in the solution and answer on the basis of India's 33 only.
See, they've issued 9% preference shares by 14x1 to be redeemed after 31/3/20x6. At the end of the third year, they had a good amount of return and they don't want to wait for 2 more years. They want to make a redemption by third year itself. So it is callable preference share, it seems. And because of the fact that they are breaking the contract, the redemption price will be 12 rupees and not 11 rupees as it was originally agreed. Because they are breaking the contract, so they want to pay premium. Whether that premium that is paid by third year, as whether it can be adjusted in net profit attributable to equity shareholders, is the main area of contention. So in the given situation, rupee 1 per share is the excess payment made by the company amounting to rupees 1 lakh in all. The amount of 1 lakh will be deducted from the earnings for 3/4 while calculating EPS for the year. So what is that we are expected to know? So Question number 1, ICI study material. So, call premium on, what is the name of that particular thing? On preference shares paid after 3 years with 2 more years to redeem. Call premium on preference shares paid after 3 years shall be deducted from net profit attributable to equity shareholders. Net profit attributable to equity shareholders in the computation of basic EPS. Come on, kindly make note. Oil bath. AC குளிரும் டக்குனு அடிக்கும்.
Noted, sir.
Noted, sir.
Call premium on preference shares paid after 3 years with 2 more years to redeem shall be deducted from net profit attributable to equity shares in the computation of basic EPS of the third year. Yes. Illustration number 2, yes, Danesh will read out.
An entity has the following preference shares in the issue at the end of 20 5% redeemable non-cumulative preference shares. These shares are classified as liabilities during the year. A dividend was paid on the 5% preference shares, ₹1 lakh. Increasing rate cumulative non-redeemable preference share issued at a discount in 20x0 with a cumulative dividend rate from 20x5 of 10%. The shares are issued at a discount to compensate the holders because the dividend payments will not commence until 20x5. The accrual for the discount in the current year, calculated using effective interest method, amounted to say ₹18,000. These shares are classified as equity, ₹2 lakhs. 8% non-redeemable, non-cumulative preference shares. At the beginning of the year, the entity had 1 lakh 8% preference shares outstanding, but at 30th June 2024, it repurchased ₹50 lakhs of this at a discount of ₹1,000 of ₹50,000. 7% cumulative convertible preferences converted in the year. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although the previous year's dividends was paid immediately prior to the conversion. To induce conversion, the terms of conversion of the 7% convertible preference share were also amended, and the revised terms entitled the preference shareholders to an additional 100 ordinary shares on conversion with a fair value of ₹300 nil. The profit after tax for the year 20x4 is ₹1,50,000. Determine the adjustment for the purpose of calculating EPS.
Right. See, this is a problem involving a lot of preference shares there. See, there are 4 preference shares that we are taking up for discussion. First one is redeemable. That means it is a liability to the extent of capital. Non-cumulative preference shares. There is no liability associated with that. So it is regarding preference dividend. This need not be. That is the amount, and they have also mentioned that a dividend was paid. So that means the figure of profit after taxation of 1,50,000 shall be considered after deducting towards rupees 1 lakh. Remember, I was just referring about, unless otherwise stated, we should only be understanding that net profit is after deducting towards all interest. So when you find a dividend was already paid, they would have adjusted only in the P&L account, they would have given this. So once again, 1 lakh rupees you should not be deducting. That is a point that we want to say. 2. Increasing rate cumulative non-redeemable preference shares issued at a discount in 20x0 with a cumulative dividend rate from 20xy of 10%. The shares were issued at a discount to compensate the holders because dividend payments will not commence until XY. There should always be a consideration. No? I told you that in a place where I went, they did not offer me food, and therefore they took that as an insult, and every time they gave me a special focus. Likewise, you find they will not be given with a dividend until 2000 X5, but it was issued at a discount in 2000 X0. Since they are compensated with delayed amount of dividend, the issue price was compromised. Issue was made at discount because the eligibility for taking dividend comes only 5 years later. Therefore, the effective interest rate is what we are expected to apply, and by applying that, the accrual for the discount in the current year calculated using is 18,000. So they would not have paid like this 1 lakh. They would not have paid like this 1 lakh. It is only accrual is what they mentioned. So therefore, the net profit what you have as 1,50,000 would not have taken this 18,000, and therefore, for the purpose of computing earnings per share, this 18,000 has got to be deducted. Are you clear? Next one, 8% non-redeemable, non-cumulative preference shares at the beginning of the year. The entity had 1 lakh 8% preference shares outstanding, but on 30th of June, it repurchased 50,000 of these at a discount of 1,000. So, what normally a treatment is expected to be made when there is a cancellation or purchase of their repurchase of the preference shares that they've issued, the gain or the loss would not have been taken to profit and loss account because it is not matter related to operations, no, it is matter related to finance. This they would have taken to their equity directly, to the reserves directly. But for the purpose of computing EPS, we are expected to take into consideration this income, and whatever treatment they would have given may be right, but the discount generated on account of repurchase of preference shares outstanding shall be added to the profit. So 18,000 rupees to be deducted and 1,000 rupees to be added. So net effect is 17,000 has got to be deducted from 1,50,000 subject to item, next item, the last item. 7% cumulative convertible preference shares converted in the year. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although previous year's dividend was paid immediately prior to conversion. To induce conversion, the terms of conversion of 7% convertible preference shares were also amended and revised the terms entailed to preference shareholders to an additional 100 ordinary shares on conversion with a fair value of rupees 300 nil. So this portion for which no dividend is accrued during the current period, no impact is there as far as profit after taxation is concerned. So the figure of 1,50,000 from which 17,000 has got to be deducted, and 1,33,000 is the profit attributable to equity shareholders, and then They have not given us anything regarding weighted average number of equity shares, and simply they wanted to find out the adjustments to be made in the computation of EPS. Now let us just see. It is 1,33,000. They have given us the logic as why it is like that. Now let us just go through the notes what they have just given. Original discount on issue of increased rate of preference shares is treated as amortized to retained earnings and treated preference dividend for EPS purposes and adjusted against P&L to ordinary shares. There is no adjustment in respect of dividend because these do not commence until 2005. Instead, the finance cost is represented by amortization of the discount in the dividend-free period. In future years, the accrual for rupees 20,000 will be deducted from profits, but not now. So next, the discount on repurchase of the 8% preference shares has been credited to equity. So added to profit. This is what I was just telling, 1,000 rupees. Then the dividend of 5% has been charged to income account because the preference shares were treated as liability. So no adjustment is required for it because already they have deducted it. No accrual for the dividend on 8% preference shares is required because they are non-cumulative. If dividend has been declared for the year, it would have been deducted for the purpose of calculating basic EPS. Because the shares are treated as equity, the dividend would have been charged to equity in financial statement. Is that right? 7% preference shares were converted at the beginning of the year. So there is no adjustment in respect of preference dividend accrued during the period. The payment of previous year's cumulative dividend is ignored for EPS purposes because it will have been adjusted for in the previous year. Similarly, the excess of the fair value of the original conversion terms would have already been deducted from profit attributable to equity shareholders, requiring no further adjustment. And they have just given something impractical that we have Companies Act and accounting standards are not matching. What is that they say? It may be noted that as per section 53 and 55 of the Companies Act 2013, a company cannot issue shares at discount or any irredeemable preference shares. However, the above illustration has been given only to explain the concept given in India. Yes, that's what they give. So now, how this problem has got to be handled. Shall we write in our own terms? What do you say? Or if you are feeling happy with what they have just given, we will proceed further. So kindly just make note. I will write. போடுச்சா? எழுதிட்டீங்களா? ஆனால் இப்போ தான் எழுதி முடிச்சேன். வீட்டிலேருந்து அட்டன் பண்ணுவீங்கன்னு நினச்சேன். வீட்டிலேருந்து அட்டன் பண்ணுவீங்கன்னு நினச்சேன். Is that noted?
Noting,
Noted, sir.
noting on, sir.
Noting. போய் வர வேண்டானா?
Noted, sir.
At about 3:30, we will have a short break because we run for 4 hours today and not office. So if you have completed, please let me know. Say, please let me know if you have completed. I think you are all taking more time.
Screenshot எடுத்துட்டேன், sir.
Screenshot எடுத்துட்டீங்க. Question number 3. Yes, Pavanji will read out.
Yes, sir. Illustration 3. Following is the data for company XYZ in respect of number of equity shares during the financial year 2001-X2. Find out the number of shares for the purpose of calculation of basic EPS as per Ind AS 33. Serial numbers 1. Date April 1st, 2001. Opening balance is 1 lakh. 15th June, issue of equity shares for 75,000 shares. 8th November, conversion of convertible preference shares in equity, 50,000 shares. 22nd February, buyback of 20,000 shares. 31st March, closing balance to 2,05,000 shares.
So why don't you find out weighted average number of equity shares? It's not the first time we have done. We have already done. Maybe it is not the same problem. Why don't you try? I will just come in a moment.
Sir, 1,57,151.
Who is that?
Muralidharan.
I have not yet tried. I don't know about others. Now let me just try in front of you. So date, transaction, numbers, days, and rotation, the average of equity share. For 20x1. Opening balance. Please keep your mic in mute mode. 1 lakh, all 365 days. This 1 lakh multiplied by this divided by 365. June X1. Of equity shares. How much is that? 75,000. So I think there is one function is there. If I put the date automatically, it will compute the number of days. I think for the date, there is one format is there. I use that. It will
290. 290.
Huh?
290.
290.
Also
289 வருதுண்ணா.
290 தான்.
Sir, I think that is actually we need to enter the two dates and just give subtraction like that, sir. நம்ம 31st March entry போட்டு subtract மாதிரி கொடுத்தா வந்துரும் நினைக்கிறேன்.
நீங்க நினைக்கிறீங்களா இல்ல தெரியுமா?
ஆபீஸ்ல பண்ணிருக்கோம் சார் அந்த மாதிரி வர்க்கிங்.
So இது வந்து I will put this from data, end data. T1 அதுக்கு ஒரு ஃபார்மேட் இருக்கு. ஐஃபன் போட்டா வருமா?
ஆமா சார், ஐஃபன் போட்டா ஆட்டோமேட்டிக்கா ஆக்கணும் சார். இன்ஸ்டெட் ஆஃப் ஃபுல் ஸ்டாப் ஐஃபன் இல்ல ஸ்லாஷ் போட்டா அது ஃபார்மேட்ல வந்துரும்.
ஸ்லாஷ் போடுவீங்களா? த்ரீ 03 போடணுமா?
போட்டா வராதுன்னு நினைக்கிறேன். 20x1 போட்டா வராதுன்னு நினைக்கிறேன்.
ஆமா சார், அது X1ல இருக்காது சார். நம்ம ஒரு 2020 அந்த மாதிரி.
எவ்வளவு ஸ்பேஸ் எடுத்துக்குது பாருங்க அது.
மேல இருக்கிற இதுக்கு சேர்த்து எடுத்துங்க சார். நீங்க ஜஸ்ட் அது மட்டும் டிராக் பண்ணி விட்டீங்கன்னா அதுக்கு ஏத்த மாதிரி வந்துடும் சார். லைட்டா டிராக் பண்ணி விட்டுருங்க.
இருங்க ஒரே நிமிஷம். என்ன பண்ணுங்க?
OCA போட்டு
Alt HY.
Formatting.
Alt HY.
Cell type. அது ஒன்று விட்டுறது.
+1 போட்டுங்க சார் நீங்க.
மிச்சதுக்கெல்லாம் +1 போடக்கூடாது. $289 தான். பட் 289 வராது.
31st
+1
டேட்
தான்.
கவுண்ட் பண்ணிக்காது சார், லாஸ்ட் டேட். அதனால
90 தான். Next, 8th November conversion.
8th November 2021 sir. Conversion of convertible preferred shares. Sir, 8th November sir.
Conversion, huh? How many? 50,000. Correct?
Sir, 22nd February 2022. Buyback of shares.
Buyback.
Buyback.
How much is the quantity?
20,000 sir.
I will show it in the negative.
Yes sir. Sir, you know,
170. Huh?
okay sir. Okay. Closing balance.
177, 233. How they have done? Same basis only. Come on, kindly just make note. What is that? Huh?
Noted sir.
நோட் பண்ணுங்க.
நோட் பண்ணுங்க, சீக்கிரம் பண்ணுங்க. If you have just completed, please let me know. So please just confirm that you have just completed.
1 minute.
Hmm?
1 minute. Not touch.
Illustration number 4. Yes, Jitendra ji will read out this. Come on.
Illustration 4. On 31st March 2022, the issued share capital of a company consisted of 10 crores.
Huh?
10 crores, no, sir.
Sorry. Oh.
In ordinary shares of rupees 25 each and 5 lakhs in 10% cumulative non-redeemable preference shares classified as equity of rupee 1 each. On 1st October 2022, the company issued 10 lakh ordinary shares fully paid by way of capitalization of reserves in the proportion 1:4 for the year ended 31st March 2023. Profit for 2021-22 and 22-23 is 4,50,000 rupees and 5,50,000 rupees respectively. Calculate the basic EPS for 2021-22 and 22-23.
Please try this because similar looking problem we have already tried. Say they have just instead of using the term bonus shares, they have conveyed it capitalization of reserves and all that. So don't get frightened. Please try. Now let me just take up
Completed, sir.
illustration. Point number 1. Since the preference share capital is classified as equity, preference dividend attributable to preference shareholders would not have been deducted from the net profit given in the problem. So deduct preference dividend as it is cumulative in nature. Correct? 3. Twenty 21 22 2022 Yes. Net profit. How much is that? 4,50,000 and
4,50,000 and the 5,50,000, sir.
preference dividend 5 lakhs into 10%, that comes to 50,000. Huh?
Yes, sir.
Attributable weighted average number of equity shares. How much is that?
Sir, originally issued capital is 40 lakh shares, sir. 100 million divided by
Now over there, now the part PDF
rupees 100 million and 25 per share.
Please. இது பண்ணாதீங்க. சவுண்ட் வந்துட்டே இருக்கு. பேசுறதுக்கு மாத்திரம் யூஸ் பண்ணிக்கோங்க. Weighted average number of equity shares equal to 1,000 lakhs divided by 25. Correct? 1,000 lakhs divided by 25. Correct? Bonus shares. How much? 1 for 4 held. Basic EPS. $10 and 8. Previous year, current year. Okay. Mathi potu. Is it okay? So now we will have a short break. Okay.